Hey everyone, it's Eric Shattuck here from Safeguard Wealth Management. In today's video, I want to talk about two common Roth conversion mistakes that I see a lot of retirees as well as advisors making. And these are extremely pervasive mistakes that come from a miscalculation on how to weigh the value of a conversion today versus taking that money out down the road over time. Okay, and again, these are extremely common. I see these type of questions from retirees each and every day within our practice, and I want to make sure everyone that's watching this video doesn't fall into this trap of making these same miscalculations, because at the end of the day, it's just going to cost you more in tax dollars throughout your retirement. Okay, now before getting into what these mistakes are, if this is your first time on our Safeguard Wealth Management YouTube channel, or maybe you've watched a few of our videos, we release videos every week on how to gain more from your retirement assets, how to use the assets you already have to propel your retirement forward. Everything from investment planning to tax planning to Social Security and healthcare planning. So if you're not yet subscribed, you may miss out on future videos where we release just like this. So make sure you hit the subscribe button, hit the notification bell, be notified of all future videos that we release. Okay, so let's get into it. I want to talk about two common conversion objections that really lead to these mistakes. And by the end of this video, make sure you watch to the end of this video because I want to completely dismantle both of these common objections. So the first objection is you don't want to perform a Roth conversion because it means less money is invested for you and growing for you in the future. Okay, so the idea, if we just think about what a conversion is, you're taking money from a tax-deferred account, you're paying taxes on that account today in order to convert to a Roth IRA and never pay taxes on that money again. So sometimes people view paying the taxes as money leaving your tax-deferred account. So basically that those tax dollars are leaving your retirement. So people think that, okay, if I leave more invested in a tax-deferred account, that money is going to grow a lot bigger than if I take money out of that account, pay taxes, and let that same money grow in a Roth IRA. And I want to completely dismantle this miscalculation because it's simply not true. Okay, we'll show that in just a second. But the second objection we often see or hear are people saying you never want to pay taxes out of the conversion because basically it destroys the value of the conversion. And again, this is simply not true. It comes from a miscalculation of understanding what the base case is. So again, I want to dismantle both of these objections throughout this video. Make sure you stay till the end to see both of these objections dismantled, if you will. So let's start out with basically the broken idea, this idea that paying a conversion means money's leaving your retirement and it's really sacrificing money down the road. This simply isn't true. We're going to take a $100,000, we're going to take two cases basically, a $100,000 tax-deferred account, and then we're going to take another case, this Roth case over here is basically paying taxes today, converting that money to a Roth, and then never paying taxes again on that money. Okay, so we're going to use basically the same assumptions in both scenarios. We're going to assume a 6% growth rate and a 22% tax rate. Okay, and this is very key here. If the tax rate is the same, you'll have the same ending value. Okay, so let's take the tax-deferred account first. Again, we're growing by 6% per year. So in this tax-deferred account, we're not paying any conversion taxes right off the bat. This full $100,000 is stayed invested. So we see the first year grows to $106,000, and then we see it compound through time. And by year 10, you're looking at $179,000 that basically this $100,000 has grown to. Versus, let's say that you pay 22% and convert this full $100,000 into a Roth. Okay, so obviously we're not starting out with a $100,000 balance. We're having to pay this 22% tax. And so now we're only investing $78,000. And so you'll notice through time, it very much looks like on paper, this Roth conversion was a huge mistake. In year one, you're at the end of this year, you're at $82,680 versus $106,000. So again, on paper, it looks like it's a huge mistake. It looks like this objection is completely true. But as we move through time, again, you can see this on paper balance basically staying, there being a gap between this on paper balance. But what happens at the end? Okay, if we're looking at the after-tax value, so let's say that you withdrew this full $179,000 and you had to pay, again, 22%. Now, I realize if you withdrew that much, you'd span more tax brackets. But again, let's say you pulled that all and we're paying the same exact tax rate, 22%. Well, you'll notice you end up with the same ending balance. So the mathematical rules of compounding show that it doesn't matter where you pay that 22%. You can pay that in year one, you can pay that in year 5, you can pay that in year 10. The after-tax value will show that, again, whether you pay 22% right off the bat or you pay 22% at the end, you will have the same amount of money. So this idea behind conversions costing you growth, costing you money because you're having to pay taxes right away is completely wrong. Okay, people don't understand, again, the basic compounding math when they're looking at that. Okay, so let's go through a different idea or a similar idea to this, because most people would say, okay, but I'm not going to withdraw this full $179,000 in 1 year. What happens if I withdraw it over a few years? Again, the same thing plays out. We're looking at 6% growth rate, looking at 22% taxes paid. I'd eliminated most of these years in here because, again, you don't need to see the growth growing at 6%. You'll notice these numbers match up completely. And let's say from year 11 to year 14, this person wants to take $40,000 out net of taxes. So it's pretty simple. In this Roth, they just take these same $40,000 out net of taxes each and every year because they don't owe any taxes. Okay, versus if they were going to take that same $40,000 out from this tax deferred account, they can't just simply take $40,000 out because they're going to have to pay taxes at this 22% rate. So instead, they have to take $51,282 out. And what you'll notice through time, again, on paper, it might look like there's a different value in each of these accounts. But again, this is a vanity metric. If we understand after-tax value, we will understand that by the time you exhaust both of these accounts with these withdrawals over time, again, you will see at the end, in year 14, there's $1,751 left at the end of the year versus $1,366. Okay, and if you take this $1,366 out in year 15, again, you're going to have to pay taxes. You're at the same exact amount. So it doesn't matter what the growth rate is. It doesn't matter what the tax rate is. If the tax rates are equivalent, you will have the same equivalent value at the end. So again, the reason there's a separation is because one is looking at pre-tax value, the other is looking at after-tax value. So you have to understand, we need to be looking at after-tax value, looking at the same exact ending value in both equations. And if you do, these will be equal if you're looking at the same exact tax rate. Okay, those will be equal. And again, some people will, I'm sure in the comments will say an objection of, okay, but before I even hit the 22% bracket, I'm filling in lower brackets like the 10 and 12% bracket. And of course that's the case. When we're looking at conversions, we're not looking at a $100,000 conversion in order to replace some year down the road where we're performing a full conversion today at 22% in order to replace and having a full tax-free year down the road. That's not the goal with conversions. With conversions, we're trying to perform a conversion today at a certain rate in order to avoid being pushed up into certain tax brackets, certain marginal brackets down the road. Okay, so again, what we want to compare is the tax rate that we're paying today versus the tax rate we're paying given that same amount down the road. Okay, so there's this idea called tax equivalency then. Okay, you saw the math work out. If we're paying the same exact rate today as we'll be paying down the road, so we're converting today at 22%, and down the road we're trying to avoid paying 22%, guess what? It doesn't matter. It equates to the same exact value. Okay, it doesn't matter. 22% today at the beginning of year 1 versus 22% down the road in year 20 or year 30, it's the same exact ending after-tax value. The reason Roth conversions make sense in scenarios is because you're paying a different rate, which equals a different value down the road. So the idea behind Roth conversions, where they become powerful, is when we're paying at 22% today in order to avoid 25% down the road, or in order to avoid 27.75%, to avoid some marginal bracket that's higher than what we're paying today. So this idea that you have more invested by not converting is a complete vanity metric. Okay, again, it's someone who's miscalculating out, not understanding compound math. Again, these values are different. And this one looks like it's higher, but that's only because you're not calculating out after-tax value. You're looking at pre-tax value versus after-tax. Pre-tax value is a vanity metric. Okay, yes, it looks like you have more on paper. But again, it's a vanity metric. You want to know how much you actually own, how much you actually have. Okay, so there's this idea of tax equivalency, same rate equals same value. Now, a quick aside, okay, and this might be a kind of a different case that I would make, performing the same rate in order to avoid taxes, even at the same rate down the road. So, and we're specifically talking about today's tax climate, looking at the national debt. So we host educational events all around the Midwest, primarily in Wisconsin. And in every event that we host, whether it's on Social Security or tax planning or anything in between, Medicare, whatever, I make it a point to ask the room, where do you guys think taxes are going? Raise your hand if you think taxes are going higher in the future. And time again, it doesn't matter what topic we're on and what kind of room it is. Okay, almost everyone raises their hand. And again, why is this? It's basically because we're thinking about the national debt, thinking about how much of a national debt crisis we have, and knowing that taxes rising are one of the only ways we can deal with this this national debt crisis. So given today's tax climate, if the majority of us think taxes are going up in the future, and I'm in this camp as well, let's say we're converting at 22% today, and we analyze that we're going to, and sorry for my bad writing, I'm writing with my mouse here, and we think we're going to be paying 22% down the road. Okay, so the idea of tax equivalency here is that, again, there would be no difference in making this move. Okay, if we paid 22% today to avoid 22% down the road, again, a tax equivalency case would say it's the same value. It doesn't matter either way. Are these actually the same equal outcomes though? I would make the case not. If we all think taxes are going up in the future, there's one thing we're doing today by paying 22% to avoid 22% down the road. We're eliminating a tax hike risk. So given that we're looking at the same rates, I think you can make a pretty strong case that even if you're converting at 22% to avoid 22%, that might make sense because again, if we think there's tax hike risk down the road, you're eliminating that tax hike risk. Because again, who knows if taxes go up? Who knows how much they'll go up? But even if this goes up 1%, this goes to 23%. Again, now there's a benefit to that conversion. Now the opposite is true as well. If you're wrong and you think taxes are going up, but they actually go down in the future, well, all of a sudden converting today didn't make sense. So again, it depends on kind of where your thoughts are on where taxes are going. If taxes are the same today, again, if you think taxes are going up in the future, regardless of how much they go up, making that conversion today, even though, again, it looks like it's going to be the same value when we look at current rates, you're eliminating that tax hike risk. Okay, so the other thing I want to touch on, big mistake that I see people making, assuming that paying taxes out of the conversion completely eliminates the benefit of the conversion. Okay, so you basically have two options generally for paying taxes. You can pay it right out of the conversion. So let's say you're converting $100,000 and you're paying 22% in taxes. So rather than converting the full $100,000, you're actually converting $78,000 and $22,000 is going to taxes. So that would be paying the taxes out of the conversion. The second case would be, let's say you have a checking account, a savings account, set out on the side. You have a fair amount of money within that account. The second case would be you perform that conversion and you make the full $100,000 conversion. You pay the $22,000 in taxes out of your checking and savings. Okay, most people view this as the base case. This is not the base case. This is the optimal case. The base case is actually paying the taxes out of the conversion. Okay, let me show you what I mean. Okay, so how are taxes typically withdrawn in retirement? Okay, so if you're pulling money from a traditional IRA to fund your lifestyle in retirement, how are taxes typically withdrawn? Well, they're typically withheld from your monthly distribution. So they're withheld for a few reasons. Withholding taxes properly avoids miswithholding taxes and being forced to pay quarterly estimates. So every time I see somebody that's taking a certain amount from their traditional IRAs, they're withholding taxes right out of this distribution. This is good. Okay, this is ideally what we want to do. But if we think about what that creates, what kind of scenario that creates. Now we're looking at taxable income here, so we're taking the standard deduction out of this. So really the total that we'd be pulling from our IRA would be $110,000, okay, for income that we're going to live off of, okay? And our taxable income is $84,900 because we're taking the standard deduction, $25,100 out of this amount. Okay, so taxes, federal taxes then would be $10,175. Again, if it's being withheld from your IRA, this means that full amount, taxes and withdrawals included, is coming from your IRA. So really, the total amount of money coming from your IRA is something like $120,175 because you're adding this in with this. It's all coming from that IRA. Okay, so back to tax equivalency. Let's bring this tax equivalency idea back in. I want to make the case that the base case is paying taxes out of the conversion. So we should be fine paying taxes out of the conversion. Again, it's not necessarily optimal if we have the other abilities to pay elsewhere, but again, it's our base case. So again, if we're paying taxes out of the traditional IRA, normally when we distribute, that's the same as if we make a conversion, make a $110,000 conversion here, and we pay $10,175 in taxes. Really, $120,175 is coming out of our traditional IRA in both examples. In one example, we're taking it as income, and we're paying the taxes, and again, taking it both out of our traditional IRA. In the other example, we're taking it as a conversion and paying taxes, again, out of our IRA. So these are equivalent examples. So if we're performing a conversion today to avoid this, so if we're doing this scenario today, in order to avoid this scenario down the road, again, these are tax equivalent. So our base case should be that we should be fine paying taxes right out of the conversion. Where we get an extra benefit is when we're paying the taxes out of a cash account or a taxable account. The reason being is because, again, outside of the tax protection, again, first off, we're getting the full conversion within our Roth IRA. So that full conversion is now being protected. So that $120,175 is now invested and being protected for you within that Roth. The cash account, one is probably earning next to nothing versus the Roth IRA would be tax protected. Number two, it's a less tax preference account being in a taxable account. So we're taking from a less tax preference account in order to keep more in a tax preference account. So this creates an unequal scenario. It creates an optimal scenario. So ideally, if you have cash set aside that you're not using, yes, pay the conversion taxes out of this cash, but it's not the base case. The base case that we should be fine with, again, remembering that tax equivalency example, is paying the taxes out of the conversion. Now, ideally, if you have the ability to pay the taxes right out of your checking or savings account, this makes more sense, yes. But the base case is paying taxes out of the conversion. So don't be afraid of this scenario right here. It doesn't ruin the value of the conversion, okay? It doesn't do anything like that. Again, remember the tax equivalency scenario. It would be the same exact scenario as this. So if we're doing this today in order to avoid this, again, that's fine. Okay, it creates the same exact scenario. It doesn't ruin the value of the conversion. Now, if we're doing this today to avoid paying higher in taxes down the road, when this is 25%, this is 15%, and this is 10%, that's where you get the added benefit after the Tax Cuts and Jobs Act, for example. And I'll link to the Tax Cuts and Jobs Act video up in the right-hand corner. But again, two common miscalculations, two mistakes that we dismantled in this video. Again, number one, being that you don't end up with more money by leaving that money in the tax deferred account and not performing the conversion. If you're paying the same tax rates in both examples, you have a tax equivalency scenario. Number two, you should be fine paying the conversions out of your conversion, paying the conversion taxes out of your conversion. Again, it's not as optimal as paying it out of cash and checking account. But again, going back to the tax equivalency example, it's technically the same as how we'll be withdrawing money down the road. So we should be fine paying those conversion taxes out of the conversion. Hopefully this was informational. Again, we're going to be talking more about conversions going forward in the future. Unfortunately, they're a hugely misunderstood and miscalculated tax planning tool. And it's one that you want to make sure you get right because it can be such a powerful tool today. So always remember, you don't need more money. You need a better plan. If you like this video, make sure you hit the like button, hit the subscribe button. If you have any questions, feel free to put them below. Thanks for watching. We'll see you in the next video. Have a great rest of the day.